Hey everybody, it's Tom. I'm a certified financial planner and own my own firm. And today I want to talk about why I'm not freaking out about this massive market drop. Now, I know right now it's currently down 700 points, and for many watching this, that sounds like a big deal, but trust me, it's not. And by the end of this video, you'll see why staying calm in moments like this is the smartest move you can make if you're investing your own money. So first, let's start with this. Market volatility is completely normal. And this isn't the first time we've seen a huge drop, and it definitely won't be the last. If you remember back in 2008, the S&P 500 fell over 50%. And what happened after that? It came back and rebounded higher than ever. In fact, if you zoom out, you'll see that despite all the crashes, corrections, and bear markets, the long-term trend is always up most of the time. So I'd urge you to keep perspective. A 700-point drop in reality is just a blip on the radar. There's also a lot of power in long-term investing. Most people panic because they're focused on the short term, but here's the truth. Wealth is built over decades, not days. If you had invested $1,000 in the S&P 500 30 years ago, you'd have around $20,000 today. Even after major crashes, the market historically recovers and reaches new highs. Long-term investors understand that time in the market beats timing the market itself. Also, emotional investing can be a killer. The biggest mistake you can make is letting emotions drive your decisions. Because when the market crashes, people tend to panic sell. But history shows that those who sell during downturns often completely miss the recovery and actually end up locking in losses. If you had pulled out of the market in 2009, you would have missed out on one of the longest bull runs in market history. So instead of panicking, smart investors stick to their strategy, they keep investing and ignore all the noise. So my strategy for when the market drops, and this isn't advice, this is just what I do, is to keep investing. Lower prices mean stocks are on sale. I stay diversified. A balanced portfolio helps weather market storms. And I also zoom out. The stock market is a marathon, right? We should have that long-term investing mindset. It's certainly not a sprint. If anything, downturns are opportunities, they're not disasters. So who cares? Now, I've been doing this a long time, and I realize it's not always that easy to just not care, especially if you're investing for your retirement, if you're going to retire in the next couple years. But in the grand scheme of things, this drop is tiny compared to where the market will be 10, 20, or 30 years from now. The key to building wealth isn't reacting to daily swings, but rather staying the course and staying invested. And if you're wondering, okay, Tom, I get it, but what should I actually do when the market crashes? Well, I got you covered. In my next video, I'm breaking down 6 key strategies to not just survive, but thrive during a market downturn. So click here to watch it, and I'll see you over there.